Your bank collapsed last night while you were sleeping. The building is locked, the website is down, your mortgage payment is due in 6 days. What happens to your house? Most people think the answer is obvious. The bank owns your mortgage, the bank is gone, so maybe you're free. Or maybe someone swoops in and takes everything. The truth is weirder than both of those options, and it starts with a fact almost no one understands. Your bank doesn't actually want your mortgage. Let me explain. When you signed that mortgage document, you probably thought you were borrowing money from the bank sitting across from you. You weren't. That bank was just the middleman. Within weeks, sometimes days, your mortgage was sold, packaged up with hundreds of others, sliced into pieces and sold to investors you'll never meet. Pension funds, insurance companies, hedge funds in London or Tokyo. They own your debt now. The bank you walked into, they were just the store. They made their money up front from fees and moved on. So when your bank collapses, your mortgage doesn't vanish. It's not even in the building. It's in a server farm somewhere, attached to a security that's being traded on secondary markets while you eat breakfast. The company servicing your loan, the one sending you payment reminders, that's probably a different company too. And when your bank dies, that servicing contract just transfers to someone else. This is why Silicon Valley Bank collapsed in March 2023, and not a single mortgage borrower lost their home because of it. The mortgages weren't trapped inside SVB. They were already long gone, repackaged and sold, kept alive by servicing agreements that automatically moved to the next company in line. But here's where it gets uncomfortable. Just because your loan survives doesn't mean the terms do. If your bank collapses and you had a home equity line of credit with them, that's different. A HELOC is a revolving credit line. It's not sold off like a mortgage. It lives on the bank's books. And if the bank goes under, that credit line can freeze instantly. The FDIC or whoever takes over can cancel it. You might have had $50,000 available yesterday. Today, zero. And if you were relying on that to finish a renovation or cover an emergency, you're just out of luck. Your checking account linked to autopay? Also frozen. Payments bounce, late fees start piling up, your credit score takes a hit, not because you did anything wrong, but because the infrastructure you trusted evaporated overnight. Now let's talk about what happens if you're on the other side. Let's say you don't owe the bank money. You've got money in the bank, savings, maybe a lot of it. The FDIC insures up to $250,000 per depositor, per bank. Sounds safe, but if you've got $300,000 in that account, $50,000 of it is uninsured. When the bank collapses, you're now an unsecured creditor. You get in line with everyone else, and depending on how bad the collapse is, you might get 70 cents on the dollar back, eventually, in a few years. This actually happened. Washington Mutual collapsed in 2008. It was the biggest bank failure in U.S. history. If you had uninsured deposits there, you didn't get them back for a long time. Some people are still fighting. But the mortgages, those kept going. Payments kept processing because the mortgages were never really WAMUs to begin with. Here's the paradox. The system is designed so that your debt survives, but your access to credit doesn't. The loan you owe is immortal. The loan you need can disappear in an afternoon. And there's something else. If enough banks collapse at once, the companies buying and servicing these mortgages start to panic. They stop buying new ones. Mortgage rates spike, lending freezes. Suddenly, no one can get a mortgage even if they qualify. The 2008 financial crisis wasn't just about banks failing. It was about the entire mortgage market seizing up because no one trusted the paper anymore. Your mortgage survived, sure, but your neighbor couldn't get one. The market stopped. Now zoom out. There are 4,000 banks in the United States. Most of them are fine, but every few years a handful collapse. In 2023 alone, 3 mid-sized banks went under in the span of weeks. It didn't spiral into chaos because regulators stepped in fast, and because the mortgage system is now built to be fireproof. Your loan is untouchable. It's been securitized, stress-tested, locked into a legal structure that outlives the institution that created it. But that also means you're stuck with it. If your bank dies and rates drop, you can't just renegotiate. You're dealing with a faceless entity now, a servicer who didn't write the loan and has no incentive to help you.
The flexibility you thought you had, gone. So what happens to your mortgage if your bank collapses tomorrow? Nothing. And that's exactly the problem. The loan survives. Your relationship to the institution doesn't. The payment keeps coming, the building is gone, and you're left wondering who you're actually paying and whether they even know your name. The system works, but only for the system.